Okay, we'll give people another minute. Looks like the waiting room's filling up. Right. Let's go ahead and kick it off. Thanks everybody for joining us today. What promises to be a lively discussion about business transitions. Here at Kill Point, we've helped many owners navigate the emotional and financial complexities of selling what ends up being typically their largest asset and greatest asset. Most of the times they've invested blood, sweat, and tears into these businesses, and we understand that, it's more than a transaction. I'm Michael Stanley. I'm a wealth advisor at Keel Point, and I've got the pleasure of being joined with some business transition experts that I work with frequently. Um, they've all got interesting insights and perspectives on how, when, why, and the other host of issues that go into selling your business. First up, we got Vaughn McCrary. Vaughn's currently the chief of staff and head of strategy at Brindley Fire Services. He's also a former investment banker. He has some thoughts that he's going to share about business financials and how to communicate to the market the value of your business, as well as how these things are typically structured and what the timeline looks like. Joe Fitzgerald is an associate in the corporate securities practice group at Bradley, Arant, Bolt, Cummings. That's a national law firm, and in his role, he really focuses on pinning down all the thorny legal issues that go into a transaction. Finally, got Dale Watering. Dale's the former CEO of MedTherm Corporation, and he's had real world firsthand experiences in transacting his business. In fact, this group has all worked together, Dale included. As you can see from the picture on the slide, Dale is enjoying his retirement at this point. So thanks everybody for joining us today. So starting out with talking about business transitions, broadly speaking, there's three real ways to go into that process. Number one is a family succession. If there's a business active child or business active family member that makes sense to take over the company, we can structure a transaction whereby that person either quickly or over time takes over ownership of the company and continues to run it. The next possible path is a management buyout. And it's really similar, except that the people that we're going to be transitioning the business to are those key players in management at the company that are going to take that business and steward it for the long term. Third route is a third party transaction, and that's the one that we're going to spend most of the time talking about today. All right. So starting out with some panel questions, Dale, as you entered this process, thought about exiting your businesses, what were some of the key concerns and considerations, both on the business side and the personal side, that you had to enter in this process?
Good question, Michael. The On the business side, it's always about your people and the personnel that really have worked hard to get you and the business where it is. So, from a business standpoint, we wanted to make sure that our employees were taken care of. At when we sold MedTherm, we had a unique um, review process for employees where we reviewed them every 6 months, and if they were on par, they could get up to a 6% raise per year. So that was one of the things that really was a business success point for us, and we wanted to make sure that was in writing and going forward on taking care of that. From a personal standpoint, it's now what I do. You got to have all that stuff figured out in your mind. Like a good friend of mine said, retirement is very good if you have something to keep you busy. So I had plenty of things to keep me busy as far as hunting and fishing, and had that all lined out, and had actually been working on that for several years in advance for your exit strategy. So one of the things from a personal side is if you're thinking about it, it takes time to get to the point where you want to sell, but make sure you've really thought about what you're going to do after you sell, because it can be very, very boring, or it can be very, very exciting. And it's all up to you on what you want to do with the remainder of your life. And the other personal thing that that I worried about, and I tried to do this throughout my career, is really keep in shape, because after you retire, there's so many of my friends that retired and weren't healthy enough to do what they wanted to do in retirement. So fortunately, I was young enough to retire and sell these businesses. And along the way, I really kept my health up and make sure that I was able to do what I wanted to do in the future. And that's running around the woods and riding motorcycles and hunting and fishing. So,
Yeah, I remember a conversation we had about, just, hey, I want to have enough time left in life to do all the things I want to do. And you had a pretty robust list of those things going in process. I thought that was huge. Vaughn, kicking it over to you, if we're talking about lower middle market and smaller companies, oftentimes, at a local level, there's no great comps. How does one start thinking about what the value of their business actually is?
Sure. Yeah, it can be quite a large range. It's larger transactions, of course, trade for higher multiples. And when I say multiples, the way generally valuation is done, people look at the profitability or EBITDA or cash flow of the business and then attach a multiple to that. Um, and for very small transactions, I mean, you see some sort of 3 and 4 times type multiples of EBITDA. For larger, um, growing, kind of robust, checks all the qualitative boxes like management team, recurring revenue, et cetera. I mean, those can be in the teens and on up. I think a good, sort of baseline is, a 5, 6, 7 times type multiple. And if you think about it, I think this is maybe somewhat helpful. A 5 times multiple, kind of implies, from a steady state perspective, a 20% return. You can go buy treasuries and get, whatever those returns are, Michael, few percent, very, very little risk. You can go put it in the stock market, get, who knows, 5 to 10%, high single digits. And then as you start looking into the private markets for bigger transactions and things like that, you get into the teens, whether it's real estate or whatnot. So yeah, I guess, again, that's kind of how some people will back into that 5 times multiple, kind of 20%. And again, it goes up or down based on size, based on growth, based on a number of factors. So it's a wide range, but I think that's a good starting point.
Yeah, when you talk about that kind of multiplication equation, you've got your EBITDA and then you've got your multiple. Is it, oftentimes we talk about, and I'd love to hear your thoughts on this, really the EBITDA is kind of what you've done, and the multiple is kind of what the market expects you to do in the future. Is that a decent way to think about it?
Yeah, yeah, no, that's a good way to think about it for sure. The EBITDA is, people are looking at that historically, and then typically thinking that the future would be something similar. I mean, there are cases in which you can justify a much higher EBITDA than historically from a valuation perspective. Again, to kind of caveat all this that every situation is unique, but that's right. Then from a multiple perspective. Another way people think about that, of course, is just looking at comparable transactions. Um, can be a little bit challenging and, kind of for small and medium-sized businesses, given that they're privately traded, but, a good kind of advisor or investment banker is going to have access to those and be able to kind of help folks think through that and give them some good guidance around what to expect from a valuation perspective.
Gotcha. Yeah, thanks. Joe, as we're talking about like kind of, pre going to market as we're thinking about transactions and thinking about potentially selling a business, what are some of the kind of key legal issues that really need to be squared away, thought about, nailed down? Um, Maybe not prior to engaging an investment bank, but definitely early in the process before we market this business.
I think I'd say a broad kind of overview would be from starting at just kind of your corporate organization and kind of would be corporate house cleaning. right? Many of your businesses that may be large but tightly controlled, you know, because of just how, you have maybe a single owner or a family owner who maybe haven't always kept up with those things, and any buyer is going to really want to look through to the beginning of your business kind of going forward with regard to your corporate organization. You need to be able to demonstrate who owns it. And I know it sounds silly, but think about, you created the company and then, that's it. You never get bylaws or stock certificates, things like that. And then, kind of moving forward to that, probably into talking to your financial advisor, your investment banker, looping in your accountant early on also as well, to kind of a lot of times what's going to drive, and from my experience from a legal standpoint, the structure of the transaction is going to be driven by partly taxes, right? What amount you expect to bring home, what do you think you're going to get paid, and then the feasibility of taking control of the business, and you'll look through that and say, okay, well, it makes sense to do an asset purchase agreement because of the fact that the buyer's likely going to want to reduce liability, and we don't have a ton of business that's not necessarily it's going to be difficult to assign, versus we've got a fair amount of contracts and all of them contain anti-assignment provisions, and but maybe not change control provisions, things like that. And then going back to the tax thing, kind of tied together what your current tax structure is. If you're a corporation that has elected to be taxed as an S corporation, that's going to potentially drive what type of transaction structure you enter into, depending on who the buyer is. But specifically with regard to potentially a private equity buyer, you might have to do some type of corporate reorganization beforehand as part of the transaction, and a lot of that can be kind of fleshed out early on with getting with your CPA along with your financial advisors. And then that comes back to us from a legal standpoint of trying to get you in a position to enter into the transaction.
Yeah. So it sounds like, I mean, traditionally when you think about kind of a deal process, we engage attorneys early, but really the heavy lifting starts kind of around the LOI phase. But it sounds like from what you said, there's a lot of value in kind of connecting with that legal team early. We'll talk later about building your professional team. But definitely, I'm assuming if somebody walks into your office and says, "Hey, I'm ready to sell," these are all the points that you're going to bring up.
Yeah, I would definitely say don't sign the LOI and then bring that to your attorney and say, "I have an LOI signed. I'm ready to do the deal." As there are a lot of things that you could fight for. My advice on a seller standpoint would be, you have your most amount of leverage in the beginning of the transaction. And as the transaction moves towards a closing, you have less leverage. The closer you get to the closing date, the less leverage you have. And I would want to, at the LOI stage, be in the best bargaining position. That's when you're going to be able to, whether you're going to want rep and warranty insurance, whether you want to go ahead and determine, certain representations and warranties that you want to, work out ahead of time. The deal structure, whether or not there's going to be an earnout versus a holdback, any type of rollover equity, anything like that. In that early stage of the LOI, that's the time that you can bargain for it. And even though that the most important document, obviously the one you sign to close the transaction, and what's in the LOI isn't necessarily going to be gospel, right? You're not gonna the parties can still negotiate. It will have helped to go ahead and have those discussions and work that out with your team once you decide to go to market, your investment banker, your financial advisor, your broker, your accountant, all that kind of on the front end in the LOI. And then really the purchase agreement becomes kind of just a manifestation of the broader LOI.
Yeah. Yeah. great points. Well, you know, you mentioned, and a couple other folks have mentioned, you know, times in a process. So, Vaughn, can you talk a little bit, you know, through what a process looks like, you know, how it's structured and how long they take, those parts take?
Yeah, happy to. You know, look, I think just stepping back real quick, just sort of fundamentally, you know, the purpose of a process is to generate that competitive tension. You know, Joe alluded to that around the LOI. That's really, you know, what an advisor or an investment banker is going to be trying to do is to set up a process to get the right people, the right information at the right time, and move them through that funnel until kind of you know, the LOI phase before you go exclusive, which is fairly usual for kind of small and medium-sized businesses is to go exclusive with the buyer at that LOI. Now, it doesn't always happen. There are situations, and certainly in larger transactions, you know, people may not have exclusivity and close the deal. But you know, just looking here at the slide, there's sort of this initial phase of preparation and identification of potential buyers. That's where you're sort of pulling together all the information, really creating sort of a story or a book on the company that you can share with prospective buyers. You're creating that buyer list, you know, creating some projections and detailing out a financial model, and you know, just kind of getting all your house together. You really want to, you know, once you go into the next phase and you start to market to potential buyers, you really need to stay on a pretty good timeline at that point. So again, that prep phase, yeah, it can certainly be done as quick as 30 to 45 days, but you want to take the time that you need to kind of get ready for that. And then going into that sort of marketing phase where you're having those, you know, you're getting confidentiality agreements signed, you're sharing materials with potential buyers. You know, that is one that, you know, typically lasts a month or two. And, you know, that list of folks can be a handful up to, you know, as many as a few hundred in some instances. It just depends on kind of what you're trying to accomplish, what industry and kind of appetite there is for your business. And so you again spend, you know, a month or two having those conversations, and typically you'll ask for an initial indication of interest is the sort of term of art in our industry where folks provide, you know, typically like 2 or 3 page documents saying, hey, here's who we are, here's why we're interested, here's the kind of valuation range that we're thinking based on the information provided. And that really allows you to sort of you know, filter out the people who, you know, are not thinking about valuation based on how you would think about it. Or, you know, you can only spend so much time with people in the next phase after that. And so you do need to kind of, you know, whittle the field down, if you will, at that point, and that allows you to do that. So, you know, moving past that kind of marketing phase, if you will, into kind of, you know, the stage that's from, you know, indication of interest to LOI, typically site visits will be involved there. And again, that could be, you know, a few people, a handful of people. Obviously, if you're doing site visits and, you know, maybe management presentations, there's only so much that it makes sense to bring back into that stage, assuming there's that level of interest. And so again, you know, you have a couple months there maybe, and, you know, as part of that, you also typically will set up a data room. I mean, the goal in this phase here would be to get people to do as much work, as much diligence as possible to provide you the most detailed LOI. To Joe's point earlier, you know, that's when you're going to have kind of the maximum amount of competitive tension, be able to negotiate all the kind of finer points of your deal rather than trying to do that post LOI. So, yeah, that's the goal of that stage there. And then once you sign that LOI, and have that negotiated, it's typically kind of a race to the close. You know, again, a range here can be done almost as fast as, you know, it can be done very fast, but I think a good kind of expectation is 60 to 90 days. So, and that part is where, you know, a lot of legwork is being done by the attorneys. Typically, some third-party advisors would come in, like accountants, to do a quality of earnings. You know, depending on the transaction, you could have people coming in, kind of looking at sites, doing environmental work, things like that. So yeah, that's kind of a high level overview on the process. Happy to answer questions on that, Michael.
Yeah, just, one quick question, in phase five, as we're talking about due diligence. Can you talk a little bit about how, or at least the structure whereby the information that's being gathered during the final due diligence, and Joe, this may also be a question for you, but is incorporated into that final purchase agreement, or when we start talking purchase agreement and amending and changing or not, that document moving up to close when we actually sign that thing and close this deal?
Yeah, I'll kick it over to Joe here on just a second. I think the point I'd make is that typically, you got some of these long due diligence checklists that are not fun. But you're kind of collecting all that information, putting it in a virtual data room. Everyone's reviewing that, and the attorneys are reviewing it as well. And it is driving the way the purchase agreement kind of gets finalized and negotiated. And there's sort of a schedule. And there's some schedules in the purchase agreement that reference it. So all that information is used ultimately going into the purchase agreement. Joe, feel free to talk more about that and maybe talk about how it kind of works structurally with reps and warranties and things like that.
Yeah, I would say kind of it's good to have patience in this process. Because you're likely going to be asked, Dale's had to live the same thing, 5 times, 5 different people in different ways. In my experience, usually once you've entered the LOI, phase has been executed, and a lot of legwork, if you've engaged a broker, has been done by the broker, right, in this phase. They have helped do a lot. They've usually set the data room. They've already kind of staged a fair amount of it, but then eventually kind of a diligence checklist gets sent over, and it's usually pretty expansive, and will be separated into various categories, whether it be legal, insurance, employee matters, business matters, such as contracts, things like that. And then it'll usually be prioritized, right? The stuff that really the buyer's really concerned about, right? The high priority items, but they're all important. And you just want to be responsive to it. And so that initial checklist comes out, and that might just be from the buyer's team, right? And then they've already engaged counsel, but maybe they've got internal checklist because they do these deals all the time. But then there'll be usually another checklist that comes out, with the assistance of the buyer's legal team, if the first one wasn't done that way. And it will have more items that are requested. And it's an ongoing process of kind of just a disclosure. And my feelings on it are it's better to, obviously have discussions with the counsel and with the advisors, but it's probably better to over disclose than under disclose, at least to your legal counsel, so they can help you make sure you're being responsive. But it'll be a long process. For many people, it's the first time they've done it. It's very painful. You're trying to find documents you may have never really properly kept before, or necessarily in the manner that makes them easily where you can easily obtain them. In many of these instances, you might have to go to the other parties and ask for the agreement, and ask them to provide it to you. You're going to have to speak with your, loss run statements, things like that, from your insurance broker. And then all that leads to, in almost every purchase agreement that I've ever seen, you will have representations and warranties that are essentially lists, promises, statements from the seller to the buyer about the business. And it might be something as simple as, here's a list of all my employees and when they were hired, what their current compensation rate is, their PTO, to here are our benefit plans, 401ks, things like that. To, hey, in the last 12 months, I haven't done these lists of things except as I've told you that I've done them. Or, these are my, here's a list of contracts, or here's a list of contracts that require consent. Those don't require consent. And for a lot of, in my experience, and Dale, I think you and I, we went back and forth on this. There are many agreements you really don't realize that the expansiveness of some of the terms and conditions, because maybe you've operated primarily off, smaller purchase orders that have linked terms and conditions. So you got to go to a website and go and download the most recent version, and then those all interplay. But at the end of the day, when you submit this, when you attach those disclosure schedules to the purchase agreement, it needs to be as complete as possible, because that protects you, right? When the buyer is going to seek if there is a loss associated with something wrong there, right? You made a statement that you didn't have this problem, but you really do, and then those usually directly interplay with the indemnification provisions at the end of the purchase agreement. But I will say is that, when you're Dale, I think when we had with your transaction, with the broker team that we had, which is fantastic, they're helping you in that process, and really it's kind of, they're helping you with putting stuff in the data room. They're helping go find stuff. Hey guys, we haven't seen this. They requested, this item. Have you seen it? And then Daniel was like, no, I haven't seen it. And maybe the broker team's like, actually, we've seen that because we helped, create these, we helped create the data room, and that's in this folder over here. And really, to put you on the spot, Dale, I mean, what would you think about that with regard to responding to the various diligence requests?
Yeah, it's you hit a key point, Joe. The gotchas are buried into a lot of those web links and T's and C's that, as a small business owner, you wear many hats, and you, if you're not large enough to have a dedicated person go through all those links, and those links change and you're not notified on the new T's and C's. So that was some of the things that having a good legal team and broker team to look through. And really, I think you dove down, and your team, Joe, dove down on those web links and found a few things that we had to take care of, but we managed to get them taken care of. But like you said, it would, being a business owner, if I didn't have that type of team, I might have signed up to say I don't have a problem, and really I did. So just to drive your point home, you really need a good team to look down through the T's and C's, and there's always something at the 11th hour that'll get you. So, and we'll probably talk about that a little later.
Yeah, I would agree with that part. There is always, no matter what. I've not most transactions have an 11th hour problem, or not even a problem, a 11th hour, I would say obstacle.
Yes,
obstacle that you have to negotiate before the deal.
Yeah, I think I actually remember one of our 11th hour issues as we worked together. Well, great. Dale, one more question before we leave this slide. Obviously long process, yours probably less long than most, but is there anything kind of in looking through this that really stood out to you as something you either didn't expect, or kind of the intensity of it was different than you considered as you entered into a transaction process?
It was really talked about just a few minutes ago. It's diving down in those T's and C's. I'm real good. I'm a visual person, so I like to have everything printed out and read it. And when any of those contracts where I had them all printed out, it was good. It was the ones that had the links buried in there. And starting out, there's a wide range of information your broker is going to ask you about, down to, your personnel policy plans, your safety plans, and that sort of thing. So a lot of that stuff, when you're going into the first phase or starting to think about selling your business as a business owner, you really need to get your own house in order, make sure all your records are where you can get them quick. And fortunately, at Bedtherm, we never threw a piece of paper away, including phone bills from 1971. So all that stuff was there. The hard part was it was all paper.
Yeah.
So we wore a scanner or two out, getting all that stuff up into the data room. And would like, when you're in that phase one, the more data you can round up, the better you're going to be to be, like Joe said and Vaughn said, in a better bargaining position before you sign an LOI.
Yeah, absolutely. I remember we were never short on information volume. We just had to locate it. Get it scanned. So moving on a little bit, I want to talk a little bit about how sellers get paid for their business. And generally speaking, there's 4 ways. So first is the most obvious. And oftentimes, as I meet with owners, this is kind of how they think about selling their business is cash at close. The percentages vary so widely that, the ones that we have on this slide may or may not be anywhere near relevant, but oftentimes, the cash that you receive when you close your business is only a portion of the total value or the price that people pay for that business. And that's for a myriad of reasons, not the least of which is risk mitigation for the buyer. Some of the other ways that we can do it are, a seller note, have the seller essentially finance the remaining portion to the buyer over a period of time with set conditions. We can roll over equity. So, instead of the new owner being saddled with this note to the seller, we can give them a piece of equity. It's not going to obligate the new owner to pay things out, but they're going to participate in the growth of the business. And then, the last one is an earnout or a revenue share. Really, an earnout allows, and oftentimes I see this in cases where there's maybe a new contract that hasn't started yet. It's not baked into the past financials of the business, but there's going to be a large amount of value created on a go-forward basis, and the seller wants to participate in that. And so we structure an earnout. Big thing here from my perspective, then I'm going to open it up to y'all to give your takes on it. We really want to try to get as close as we can to gross numbers on the earnout. If we do an earnout based on something like net income, there's a lot of opportunity for additional expenses to get put into the business and really deplete the amount of cash available to pay that earnout or that revenue share. Vaughn, let's start with you. Can you kind of just give us some high points, on these, really 4 ways to get paid and the ways that you think about them as you're structuring a deal kind of after we've kind of moved towards the LOI?
Yeah, for sure. I mean, as an advisor, I mean, obviously, and as a seller, like obviously you want, the most cash at close as possible. Typically a strategic or a corporate buyer, those tend to be more often, cash at close type deals without a rollover component. The traditional private equity deal is going to have, that again, that's most often going to have a rollover component. That private equity typically likes to see owners maintain, at least 10 or 20% of, the new entity, go forward entity. And the more the better for them. I mean, usually they still want to have a majority and have control, but somewhere in that range. I think you said it well on, the other kind of structural pieces here. A seller note can be a good bridge as long as you've got, as long as you've got confidence in the buyer's ability to repay it. And earnouts do get tricky, but they can be a good tool to kind of get you over the hump, and especially if you attach them to kind of more specific items, other than profitability, which can be a little bit of a challenge. So yeah, I mean, I guess the one kind of interesting one I might make is that, a lot of small, medium-sized business owners have operated their businesses for a long time and don't have any debt. And so when they go to do, they end up electing to do a private equity kind of type transaction. A lot of times those are leveraged transactions, and, think about it. I mean, typically you'll see kind of 50% funding with debt, 50% equity. And so, if you're rolling over, 10% of your proceeds, on a 50% debt funded deal, you'll own 20% of the equity. So that is one thing that I would note. A lot of my clients used to be a little bit surprised by how much ownership, kind of percentage they would get based on the amount of proceeds they would roll.
Copy. Yeah. And Joe, could you elaborate a little bit on some of the gotchas with the earnout and revenue share structure?
Yeah, I would say kind of my overall point, with the earnout, would be, I would want to be comfortable that what you're getting at closing, you're happy with, and you're going to do the deal with that. Like you would do it for that. The earnout needs to be, in my opinion, looked at as something that, is a great to have, but not necessarily a need to have. Only because, the risk is you don't get it. And then I would follow up with that is, in my experience, a good portion of that earnout is going to depend upon the parties who stay with the business going forward. So if you are the founder, you run the business, and then you're going to transition from owner operator to employee, are you going to be there through that earnout period to make sure that to help influence you whether or not that earnout, those metrics are met, right? And I agree. I think what Vaughn said and Mike, what you led with, the devil's in the detail. You want to be sure that you understand it, that the metrics are clear, and it needs to be written out the way that you want it to. There are a lot of it does not, it needs to be done that way. With a got you, I guess I would say you need to be able to write it out, right? Like there's sometimes the purchase agreement, is kind of you're writing math. So, it needs to be tight. It doesn't need to be see the spreadsheet, right? You might have an illustrative example, right, that's included, but it needs to be clear in the way that the purchase agreement is written, how the earnout will play out in the future. The defined terms need to be clear. I think you mentioned earlier whether or not you were using numbers from a gross standpoint versus a net standpoint. All that, the definitions are in the purchase agreement with regard to the earnout. And I would say continue with that theme. The parties you're dealing with when they purchase the business may not be the same parties you're dealing with throughout the earnout period, right? Those folks may go, they may get promoted, they may take a new job, and because you and the buyer or the principal with the buyer that you've been dealing with through the transaction process, you guys may be perfectly on the same page, completely and totally. And you as the seller, you are 100% comfortable with that person and their understanding of the deal, especially with regard to the earnout. But that person may change while you may not, right? You might still be there if somebody else comes in to take over from a standpoint of the buyer. And so it's key that your understanding is reflected in the words of the purchase agreement, specifically in the earnout section, and not necessarily just kicked over to an illustrative example. That would be my overview of what I think should opens up opportunities for things to not go as anticipated. In general, everybody wants the deal to work out the way they think it's going to work out, right? A win-win for both parties. The buyer doesn't want to have to reopen the purchase agreement and fine-tune the earnout provisions to, get through a disagreement, and you don't want there to be any surprises. The buyer doesn't want surprises. They don't want to buy your business and find out you have a bunch of risk you didn't tell them about and a ton of liability coming their way. And you don't want to sell your business and find out that, 30% of your purchase price is wrapped up in an earnout that you're not going to get. And the way you do that is by ensuring that it's written clearly and unambiguously in the purchase agreement.
Yeah, no, that's good stuff. Dale, how obviously in your deal there are kind of pieces of different parts of this slide. How did you get comfortable with kind of a not all cash at close deal as an owner? I'm not sure exactly what your expectations were going in, but what was that process of getting comfortable with the structure like for you?
Yeah, well, it was gets back to the broker team that we had. Really going in as a small business owner, it was like, yeah, cash and carry, guys. Let's get it and go, so you don't have to worry about it. But through the process, and when we were doing, had a lot of very positive interest. Had several great offers, but we finally got comfortable with one of the purchasers, and when we entered into LOI, that's when I think Vaughn mentioned that they would probably be amenable to some rollover, and there's a risk involved, right? So that's a whole nother level of due diligence that you as a small business owner have to now request from the potential buyer. and just having a good broker team that had been through that process, it really worked out well. I used it as a sanity check. I tried to throw a bunch of a larger portion of the purchase price into the rollover, and I did that just as a sanity check. If they jumped onto that, that kind of gave me an idea that they might be not as cash rich as I thought they would be. But when we threw a number out and they negotiated back down. It was a win-win. Again, a lot more information that you have to get from the purchaser, and being a technical guy, that's where it came back really, really positive to have a good broker team and a good law firm behind us to make sure that what they were proposing back would work out from not only a financial but a legal standpoint. So I like the rollover, but like Joe mentioned, it's a crapshoot, right? You're rolling the dice one more time.
Yeah.
So if they buy you, they might not ever sell. You may never see that. So be happy with the purchase price of the cash you're going to get in hand, like Joe alluded to. And if the rollover works, it's really icing on the cake, and it worked for us.
Are you saying it's a positive sign that they didn't want to let you buy more?
Yeah. That's what I was looking at. I wished hindsight. Yeah, I wish they took it all, but but I thought that was a sanity check that, and maybe it's just me being naive and first time through something like this, but yeah, I did. I kind of tested it, and they backed off, said, nah, maybe not that much. And hindsight's 2020, because they had a great plan that I wish I knew before I signed it, but it worked out well. Very, very pleased with the process. But again, when you do that rollover deal, it's money you may never see. So just accept that and go on.
Yeah, I think that's a great, just having a sanity check there and thinking through, what's the reality of this investment? Because at the end of the day, you're doing an investment.
Yeah.
So kind of moving on into panel discussion and a little bit of Q&A. Vaughn, I'm going to start with you. So, what kind of broad strokes? I know we've touched on a lot of these, but if you had to distill it down, what are the kind of the key, heavy hitters that a business owner really needs to have made his mind or her mind up about before they kind of really get the ball moving in a process like this?
Yeah, I think I think you've got to have, a really clear kind of rationale for why you're doing what you want to do and what success looks like. I mean, it's helpful to kind of have that crystallized, certainly, I'm sure from everybody's perspective here. Like, what are we trying to achieve? Are you just done because you're tired? Are you trying to hit a certain purchase price? Thinking through a lot of that. And I think a lot of that comes out in, the educational process of like, here's what your options are, like realistically. Like, I think it can be a little bit difficult for people to kind of say what they want before you give them some options. So, it's that back and forth. Here are the legitimate options. Do any of these sound good? And if so, why? And then starting to crystallize the why around that. Is it, hey, I really want a partner because I see all these opportunities to go grow and do these things, but I don't want to take all that risk. I'm older and I want some support. I mean, we see that quite a bit. So anyways, I think just really thinking through the why is the good first start. And then a lot of it starts to become kind of getting your house in order, seeing what, the financial performance looks like. I mean, there's considerations as well around, what is kind of the industry looking like and what is the kind of market investor appetite for the industry? What is your specific business performance within that? Is this the right time? Are you kind of coming off a down year? Are you trending upwards? I mean, all those things matter. So anyways, there's a lot of discussions that can be had on the front end and that should be had.
Yeah, no, that's perfect. And kind of to that point, Dale, talk a little bit about how you made the decision. Why did you want to retire? I know we haven't really talked about it, but you had a company before, MedTherm, and you'd kind of gone through a little bit more disjointed of a process. What got you there?
Yeah, really, it got back to strangely enough, a fishing trip out west. So,
Oh, yeah.
so I always enjoy trout fishing stuff. So got out, actually went out west, and first 2 days I was stumbling around on these freestone streams, slick rocks, and it was to the point it was embarrassing. After about 2 days, I got what we refer to as my creek legs, and fished well and had an outstanding time. Came back home, told my wife about it, and she said, "Well, you're not going to get any younger." So that was that, coupled with I had a lot of two great business mentors, two different businesses. That one was from the Medthorn Corporation. Stayed into the company till he's 81 years old, and he said, "Don't do what I've done." And I had another good friend, a husband and wife couple, again 80, 81, worked all their life, and when they did retire, they just could not do what they wanted to do in retirement. So that was a key point for me to finally say, yeah, there's things after business. Yeah, has been our baby, but it's time to go on and enjoy life and capitalize on some of your successes on that
Yeah.
standpoint. And still to this day, I just you once you get out and you worry, you always hear these stories. Someone's retired, and 6 months later they've passed away. So that's it's weird. It's always in the back of your mind. So play hard. My advice, anybody that sells, play hard as you can while you can when you get out.
Yeah, absolutely. Well, just for all our listeners, we wanted the most professional recent photo of Dale for the slideshow, and that's the one we got. Dale's living up to his advice. Joe, kind of give us, again, we've touched on some of these, but if you had to distill it down, what are kind of the major, what I'll call legal ditches that you often run into over the course of a transaction that potentially could derail it, that could be thought about ahead of time?
Yeah, I would say that a good chunk of it comes down to consents and getting third parties to sign off on the transaction that you really hadn't thought were going to be issues. And these could be governmental consents. They could be something associated with a permit that's important to your business. It could be your key suppliers or your key customers, getting those. It could be believe it or not, the landlord or a host of landlords that has to sign off. And each one is going to have their own issue that you have to navigate through. And that's why it's important, in my opinion, to have a good relationship with these folks, but also the proper messaging. I feel like with Dale's transaction that not only he, but also his broker team helped in navigating that obstacle by messaging it correctly, so that when it was looked at from the you're notifying someone you've had a business relationship with, and you're informing them of the fact that the business relationship is about to change, and they have to get comfortable with that, right? If their sign off is required for the deal, right, it is a required consent, and they have to be very comfortable that whomever is purchasing your business, looking at Dale, because you sold yours, but looking at it from the seller standpoint, that they're it's going to stay the same. That whomever's coming in is going to keep doing as good of a job, if not, as Vaughn alluded to earlier. If you're seeking someone to help you, ratchet up your platform, it might even be better, right? That if it's the landlord for the lease, that the person who's going to be the owner of the tenant is going to still pay the bills. That if it's a key supplier or a key customer, that business relationship is going to stay the same, if not get better. And there's an art to that, because it depends on the person you're dealing with, depends on the business you're dealing with, your relationship with them, and it depends on when you're messaging it, right? Because in many instances, you're messaging it before the transaction is actually complete. And if the transaction were to not close, right, you've potentially created a kink in that relationship. So I think that's certain consents are for transactions that are large enough. Those are going to require certain governmental consents you're going to have to get, and that is what it is. But even with that, then the messaging is key in how you're messaging it to that other party that, this transaction is going to happen, and here's why, it's not a problem, or here's why it's a good thing, and here's why you should sign off with it. That would be my, my broad take on things that could derail or slow down a transaction. Because the parties
Yeah.
who decide to do the deal, obviously, if they've come to a determination.
I think that's an excellent point and one that's often overlooked. Dale, I'd be interested to hear, obviously I remember when we got to this point, how did you, Joe mentioned there's an art to it. I definitely believe that. How did you paint in terms of this part of the process?
There were some gotchas that you'd never think. It's always the one that you're not concerned or think is going to fly right by. Ours was dealing with some of the things that Joe talked about, leases and landlords and that sort of thing. It was definitely 11th hour process. And then we had one clause that was buried down into some links to the link that said we had one customer that had to have consent. And that customer is 800-pound gorilla and basically said, no, we have our process. It's going to take 6 months to a year to get this letter signed. But with the legal team, we're able to negotiate and close over that at closing. So I kind of still own that problem, but we were in the catbird seat because we make the only instruments in the world. So I used that to our advantage, I'll say. And
Yeah. How did that, how did that discussion go in terms of like, if we're thinking about risk to the buyer and, you having to own that, did you only leverage your product or were you able to add some relational leverage in there as well to get that through?
No, leverage the product, burnt a ton of bridges. So, yeah, it came down to myself dealing with the legal team of the 800-pound gorilla, and I didn't ship till they signed. Bottom line. It's like I did not give up my chip in the game, only one chip, and they relented.
I think that's really important to know, that there's obviously a negotiation going on with the buyer, but throughout this process, there are different leverage points that need to be kind of paid attention to, and we need to think through when and how to use them.
Right. And if I didn't deal with that, I mean, obviously we had some equity still in the game that we would have lost. So, my advice is if you're in a situation like that, sometimes you get your best deal by saying no.
Copy that.
Yeah.
Well, we've got about 6 or 7 minutes left. I'm going to open it up to a little bit of Q&A from the audience. And guys, y'all just hop on this if you think of anything that's insightful to say about it. First question is, are there specific questions I should always ask to potential buyers? And you could take this as, early on in the process or once we're kind of getting into management meetings.
I'll jump in on potential buyers. You want to try to get a feel that they really align with you as far as the company values, your core values, and they still want to take care of your employees and run the business from the first day as we've always done. I know when you get bought by bigger entities, things will change, process, procedures, and some legal things have to take precedent, but to make sure that they have a plan and they're going to ease into it as thoughtful and considerate as they can to your staff and your administrative staff, your back office staff, and then finally your employees as well. You don't want them disrupted so they can continue on the job, get the product out the door. So that's one question. You want to make sure you know how they're going to transition in and policy changes.
Yeah, it's a great.
Yeah, I just add to Michael. There's obviously a lot of questions you could ask, and these processes move quick, and they should, and they need to. That said, like, I feel like we always tried to kind of carve out time just to hang out a little bit, and have a meal together. I mean, those go a long way. Have seen people do things, even like going to do site visits at the buyer to go see their corporate office, meet some of the people. Just spending more of that quality time can help, people get more comfortable and get a feel for what that relationship's going to be like post close.
Yeah, that's excellent. That was a big player in this transaction for sure. Um, Next question, Joe, this is probably angled towards you, but Dale, you might be a good first shot. Is it okay to use my company's internal attorney to manage this process, or do I need to hire a specialist when going into a transaction process?
Man, always hire a specialist because your internal people are going to be ingrained into your daily business and most likely not uh, familiar enough with these other types of transactions and the type of gotchas that you got to look at from a really from a good broker and a good legal team as well.
Joe, you got anything else to add, in terms of hiring an M&A attorney versus using corporate counsel?
I really don't. I mean, I would say that not to disagree with Dale, I think it would all just depend, no, I'm not going to say that anybody's legal services are better than others. But I think it would, the one thing I will say about being on the sell side versus being on the buy side, many folks on your buy side they bought multiple businesses. They've done it multiple times, and they have a system. It's almost like a industrial system. They know the documents you're going to come out with. They've got their plan. They know who's going to go and do the site visit. They know all that stuff. But many of your sellers, are selling a business one time. For a lot of times, there's a lot of emotional capital that's put into there. That might be a family business that's 5 generations deep. They may have been, and they've gone through the highs and the lows as a family running that business, right? That business is a part of that family. It may have the family name. It may have, everything from, it might be on old family land, and it might have family furniture in it. Like there's so much emotional and family capital that might be baked into that business. And that if you have an internal attorney, that person might be familiar with that in a unique way that somebody from the outside may not be familiar with it, and they might know that certain things are more important to you than someone coming from the outside may be able to realize, because they just don't have the time that they've spent, or they haven't been a part of that story the whole time. So, and maybe in that case, it works best to combine forces, if you will. But usually in my experience, the sellers they sell once, right? And it's different. And to Dale's point, that's why you want that person who, from a buyer standpoint, who shares a lot of your same cultural values, because they're not just buying a business that you're going to forget about. They're buying something that you're going to talk about. Your grandkids are going to talk about it. That it's something that's probably touched the lives, especially depending on the community. That business may have touched the lives of hundreds of people who are around it, who, even if they didn't work for it, maybe their brother did, or their mother did, or somehow or another they're connected to it. So it's usually, in my opinion, a very highly emotional event, and maybe that internal person might have knowledge of that in a deep way. And
Yeah.
So I'm not going to give a non-answer, but I think those are factors that should be considered.
Yeah, and I think just to kind of span the gap, what I've seen work frequently and very helpfully is like that person with the kind of ingrained, deep knowledge of the history, working in partnership with a specialist, especially, depending on the size of the transaction. I've seen that work together pretty well. Dale, did you have anything to say? I didn't mean to cut you off.
The only thing is, I'll key on what Joe said. It's a very emotional event that you have to strive very hard to try to remain emotionally detached, because man, this is your baby. You might think your baby's worth $1 gazillion, but the market's going to bear what the market's going to bear. So it's a very, very hard process to separate yourself emotionally from this very emotional event. But if you can know that going in and know that you can back off and take a deep breath and say, well, okay, I'm going to detach myself a little bit. This is what the market's bearing, and like I tell anybody, they ask you what your business is worth, it's going to be what someone's willing to pay me for it. So
Yeah.
you got to kind of play that mindset, and it is a emotional roller coaster, especially the 11th hour things that pop up.
Absolutely. And that's actually a great segue into our last Q&A. We've got several more. Unfortunately, we're not going to be able to make it to due to time, but what are the major causes from y'all's perspective of seller's remorse? What equals a bad deal on the back end, even if we get to close?
Yeah,
Go ahead, Mom.
I was just gonna say, like, I think some of it goes back to, I mean, obviously picking the wrong partner. That's the one everybody sees quite often. I think also like selling for the wrong reasons. Again, going back to not having really thought through kind of why you're doing what you're doing, and if what you think you're supposed to do will actually solve your current pain or bring that current reward. Some people say I'm tired, but maybe they just needed a break and they actually love their work, or maybe they just needed to change their role and kind of find a different way to enjoy their work a little more. But like Dale, he wanted to go do a lot of things, and you seem pretty happy. So
Yeah.
so over to you, Dale.
Yeah, well, again, I'll say retirement's great if you have a lot of things to keep you busy, and think about that before you go through the sale process. There's always remorse. I mean, my remorse was, well, what if all these things I wanted to go out and do, and I don't find joy on them. But I haven't found anything about getting out in the woods and hunting and fishing every day that I've gotten tired of. So again, it gets back to the opening. Think about the reasons you are selling. Yvonne had a great point. If you're just physically tired, back up, take a break, take a vacation, go do something, rethink it. And selling might not be for you, but if you do that break and come back and say, yeah, I had fun doing other stuff besides thinking about the business, then probably selling's a good idea for you.
Mm-hmm. Excellent. Those are all great points. Y'all, thank you so much for joining us. And we appreciate all three of y'all being on. It's great to work with you on a daily basis. It's great to see you on the Zoom call. I'm gonna real quickly share a screen. So just for those listeners who may not be familiar, Keel Point is an independent RIA. We help business owners make the most out of the business that they build and provide comprehensive wealth management solutions on the back end, as well as transaction advice through the process. And we work with a host of experts like the ones that you've seen on the call today. Founded in '98, a larger firm, 3.2 billion AUM, and 25 plus financial advisors. And we're cited in the office locations on the screen. So if there's an office near you and or not, and you have questions about the things that we've discussed, feel free to reach out. You can reach out to me, mstanley@keelpoint.com. And if any of your questions weren't answered on the webinar, I'm happy to answer those, and I will get them to the appropriate party if you'd rather hear from Joe, Vaughn, or Dale. And with that, we'll call it a day. Thanks so much for joining us.